question of who you blame for this banking crisis has really become a political Rorschach test. And I've seen that there are 6 different parties that people want to blame in this situation. And there's some merit to all of them, but the degrees are very different. So number one,
Let's go through them.
Okay, number one, the bank management of all these different banks. Clearly, very poor risk management, didn't do a good job. They are to blame. However, and Chamath is right about these banks, they differ in the details, but the point is that they're all operating under conditions of extreme stress. Where did that come from? Number two, the Fed's rapid rate tightening cycle. Clearly, I think that the combination of poor risk management with the spike in interest rates, that basically has precipitated this larger problem. Number three is, I think, the Biden administration's spending, which in fairness started with COVID before Biden, but Biden really intensified it. And then I think it really compounded the problem in the summer of 2021 by claiming that inflation was transitory when it wasn't. That allowed them to keep spending and keep printing money and kept QE going for another 6 months. That created the bubble of 2021. Everything got super frothy. And then that made the rate hike cycle even more vicious because you started 6 months later. They could have started 6 months earlier and it could have been more gradual. And I think that really was a disaster for the economy. Okay, number four, the dereg in 2018. I think Elizabeth Warren and Ro Khanna have made what I would call a compelling case that the dereg in 2018 have contributed to this problem. I think in hindsight, creating a 2-tier system of banks where one tier are the systemically important banks who are completely guaranteed and backstopped by the federal government, and then a sort of lower tier, a second tier of regional banks was a poison chalice for the regional banking system because in the short term, it meant they were more lightly regulated, which may be appropriate for smaller banks that aren't these mega banks. However, it has also now, I think, created a situation where people are less confident about them. And so the money flows are going from the regional banks to the systemically important banks, the SIBs. So like I said, it might be a double-edged sword. And I think we're going to have to look at those regulations and figure out what's the right regulatory regime to create confidence in the regional banking system. We want a thriving regional banking system. And so the question is, what's the right regulations that get us there? And then the final two that we can talk about later are, I'm hearing wokeness getting blamed, which, listen, I think that wokeness was a distraction. There was a lot of crazy programs happening at these banks. But listen, if wokeness was the key factor, the whole Fortune 500 would be out of business because they all do this stuff. They all do this stuff. So I think we're going back to the well a little too often on that critique. And I don't want to burn that critique out because I think that wokeness is bad, but it's not the key reason why this stuff happened. And then the last group that gets...
And for wokeness, we could also maybe frame it as ESG more broadly as the distraction because wokeness is charged, ESG is real.
Yeah, what I would say for sure is that if these banks had spent as much time on risk management as they did on ESG or on woke, then this crisis wouldn't have happened. So definitely a distraction, but not the thing that specifically caused it. And then just the final thing is VCs. And I just can't fathom at this point, given the multiple bank failures, given that we see the larger problem of unrealized losses on bank balance sheets, that somehow any class of depositors would be blamed for this. That just makes no sense to me.
Chamath?
I think the critique is specific to Silicon Valley Bank because I think, and this article was in the Wall Street Journal, but what it shows is a really complicated, intertwined relationship between VCs and Silicon Valley Bank where VCs were given very cheap interest rate loans. They were given GP call lines of credit. They were given LP lines of credit. And then those same VCs would be directing their companies to put their deposits inside of SVB, who would then take those deposits and buy risk. Yeah. And while the reality is all of this stuff will come to light because I think it will get exposed as we go through congressional hearings on all of this. But I think pointing the finger at VCs in this specific case is somewhat warranted because there was a little bit of people working in lockstep together and there was a lack of functional responsibility around how to be a true fiduciary. So if you come to a board and your founder is 22 years old and you give that person $15 or $20 million, I think it makes a fair amount of sense that you are supposed to be the more sophisticated financial person in that room. And if you have incentives that aren't properly disclosed to that CEO, and now a set of decisions are made, I think that there should be some accountability for that, or at least some exploration of why that happened.
I just want to make sure the audience understands this because it is a bit in the weeds and it's a bit inside baseball. What you're saying, Chamath, is, if I can summarize it, there are people who are the adults in the room, venture capitalists. They have deposits at Silicon Valley Bank. They also might have loans that are fantastic with Silicon Valley Bank. I have a mortgage for this office from Silicon Valley Bank, and I talked about how, on the last episode, how great it is. They come, they open wine with you. It's white glove service that you wouldn't get at another bank. And then they might have loans against what's called the GP carry or the GP share, or they might have mortgages. And so there's a conflict there. If you're a venture capitalist and you're directing a 22-year-old CEO to Silicon Valley Bank, maybe you're doing that is, I guess what you're saying could be explored.
No, the bigger conflict of interest.
And in some cases, Silicon Valley Bank is a limited partner in all of these funds. My point is that all of these things...
Conflict of interest.
Okay, hold on. We have to explain that.
So imagine a situation. You go and start a fund. Silicon Valley Bank comes to you and says, let me be a limited partner and invest with you. Let me give you some amount of money. I don't know where that money comes from Silicon Valley Bank, but they...
Yeah.
Well, let's be realistic. More like 25, 50 million, 100 million. Okay, this is a lot of money.
Okay.
So $1 million kind of is whitewashing this problem. So you give them a reasonable amount of money. They're like, wow, I have tremendous loyalty for you. Thank you. Well, do you need anything else? Do you need personal loans? Do you need lines of credit for your business? Sure, why not? I take those too. And invariably on the back end now, your loyalty obviously builds up. Again, none of this is wrong, but this is what's happening. And then you tell your companies to keep your deposits there. Maybe the cash management program is not as strong as it would have been if you were more circumspect and you didn't have those incentives to direct people to one institution only. In any other part of the market, so in the public markets as an example, there is such a bar for disclosure. Okay, and I cannot stress this to you enough. Related party transactions, all of this stuff, we have to tell everything, not just for us, but even if our sister or brother or mother may have a transaction with an entity that we're doing a deal with. And it just isn't the case in private markets. And so it's not to say that anything untoward happened, but when people point the finger at VCs, I think they are pointing to this whole set of issues and asking the question, shouldn't there have been more disclosure and transparency around it? And now that this has come to pass, shouldn't we explore it? And I think that's what the Wall Street Journal did. They started pulling on this sweater thread. And my guess is that you're going to find a whole ball of yarn at the end of it.
Sachs, what do you think of this?
I think Chamath makes a fair point that if VCs have SVB as an investor and then they're directing startups to use SVB, that is a conflict that should be disclosed. By the way, we never did either one of those things. We never had SVB as a limited partner, and we also never directed our startups to bank at SVB. I don't know why we would ever do that. Moreover, I always try to talk founders out of taking venture debt, whether from SVB or elsewhere. So, listen.
Yeah, we've been clear about that. And to be clear, I never directed anybody to a specific bank.
I know.
I always told people to get 2 or 3 banks and have redundancy.
Totally.
Advice.
Totally. And look, founders have multiple VCs typically on their board. So the idea that any one VC directs them which bank to use is just that's not realistically what happens at these startups. But look, I think Chamath is right that when there is a bank failure or any kind of failure this big, then all the practices are going to be under a microscope and there's going to be some scrutiny of this.
Here we go.
And maybe there should be. But my larger point is we're now operating in an environment in which clearly there's a larger set of stresses on the banking system. We've already had now 5 bank failures or near failures. Moreover, do any of us believe that this is over? Or do we believe there are more shoes to drop? If we believe that there are more shoes to drop, we may not know exactly what they are, but I think all of us probably believe that we're not at the end of this. But just to finish the thought, if we believe there will be more shoes to drop, then clearly the issues cannot just be limited to Silicon Valley. They have to be a larger set of issues.